guys, right, let's talk RSI. So I'm not going to go into the details about how the formula is calculated. You can hop onto Google for that, work out all the definitions and all the kind of boring dry stuff. Not bothered about that. What I'm interested in is how we make money from the relative strength index. Now, there's a couple of ways of looking at it. I'm going to show you some broad approaches that I know people use. I'm also going to show you how it's meant to be used, and I'm going to show you one little strategy that I use and how I blend it in with a kind of broader approach. So first of all, you know, RSI is it's a momentum indicator, but it's also an oscillator. So an oscillator meaning that it oscillates between a high value and a low value. Can't go above 100, can't go below 0. So it's basically doing a sine wave format. Obviously that's simplifying things. It's not always going to be doing that, but that's basically how it's calculated. So and as I said before, it's a momentum indicator, which is showing us how strong the movement is based on how much it's moving relative to how much it's moving down, how much it's sort of moving up, then down, how the stairway is going, if you like, and then it's giving you a value. So it's sort of normalizing what you'd understandably see, or expect to see, should I say, on a chart. So let's have a look here. So your first criteria you've got is setting an overbought and oversold condition. Now overbought generally means, and again you can change this to suit you, anything above 70 or above 75 is what's called an overbought reading. Now that is basically, in simplified terms, is telling you that it's potentially running out of momentum. Now there's a very big caveat to that, is in a trending environment you can forget this scenario. So one little thing that mistake I see people making is assuming that when something's overbought, it's going to roll down again straight away. When it's oversold, it's going to go up. So you know what you don't do is you don't simplify it over too much and say, listen, when it's oversold, I'm buying. When it's overbought, I'm selling. That's far too simplified. You've got to look at it in the broader sense of what it is. So anyway, under 25, you've got what's called oversold condition. So what does that mean for traders? Well, it basically means that momentum may well be running out when the market becomes overbought. And I say may well be because it doesn't always work like that, but that's generally what we're trying to see. So how do we trade it? So the first way of trading it is to say, listen, if you're in a range-bound market, I'm trying to find a nice little example. We've just got the US dollar yen here. I'm not going to cherry pick too much because I think that's unfair and it's not the real world. But there we go, there's a good example here. I've scrolled back to, where are we now? 2015. Fairly range bound. You can see the yen's just sort of chugging along in this range here. You know, highs, lows, not done much for this sort of period of summer. For the whole year, kind of stuck in this range. Not a real classical range, but it's a range nevertheless. So when you look at the RSI, you've got a peak here, which sort of coincides with this peak area here. You've got a low, almost went oversold, but not quite on this peak here. We definitely went oversold here on this little flush down here. Then we push back up overbought, and then we push back down oversold again. You get the idea. The point is, when the market's in a range-bound environment, the RSI is going to oscillate between being overbought and oversold. Now, the theory being, and obviously this is really simplifying it and there's a lot more to it, and you're going to have to add this into your trade ideas and your risk management parameters and all this kind of thing. But the theory generally is, once the market moves into an overbought condition, i.e. RSI goes above 75, and you're in a range-bound environment, you want to look to sell short or take your profits on your long for an unwinding, for a pushback to either the 50, which would be sort of a kind of a good target area, or if you're feeling really ambitious, looking for a move to the oversold condition. So from overbought to oversold, from oversold to overbought. So that's the general theory in a range-bound environment. Let's see if we can find another quick example. I'll scroll through, just doing it on the fly here. Now this is where this is quite interesting. If you look at this range here, very tight range over the early part 2015, Christmas 2014. Again, US dollar yen we're in here, by the way, just show you that there. Very tight range. So the RSI never really gets momentum, and that actually makes sense when you look at the chart, because we didn't really get any momentum going. We were moving very small increments, and especially in this period here, you know, late March through April, early May kind of thing. Very narrow range, and that shows you what the RSI looks like when we're in narrow range. No momentum, because it's a momentum indicator and we're not getting momentum in price. You're going to find this just sitting here chugging and not really showing any extreme scenarios. So That's the overview of what RSI is. Now, what I'm going to look at next is how we can perhaps use this in trending environments, how we can use it in really extreme volatile environments, and some little ideas that we can use to actually make some money off from a trading perspective.